Attention bondholders. The Treasury Department introduced new Series I interest rate bonds, new Series I bond interest rates, as they do twice a year. But it's not all good news. The rate sits at 3.11%, which is down from the 4.28% yield offered last May. And if you happen to buy this type of bond at a whopping 9.6% rate in 2022, you may be wondering if it's still a good investment. Here with more, we've got Chip Hughey, who is the Truist Wealth Managing Director for Fixed Income. So Chip, let's start with the basic question. At this new rate of 3.11%, are Series I bonds a good place to put your money right now?
It's great to be with you, Brad. So for those investors currently holding I bonds, they are high quality instruments. They're backed by the U.S. government, and they provide investors some protection against inflation and therefore some peace of mind. But with that said, we do expect inflation to continue to cool, and therefore we will probably see this trend continue where the interest payments on I bonds trend a bit lower in the year ahead, or at least maybe stabilize around this sort of 3% level. Obviously, that's a very far cry from the 9% yields that we were seeing back in 2022.
And so with that in mind, where should you put your money instead within the fixed income space?
Well, so for comparison, right, five-year U.S. Treasury bonds yielding north of 4%, offering pretty modest interest rate risk and the ability to lock in significantly higher yields over a 5-year period. And for those who don't even want that much interest rate volatility, right, there are money market instruments still yielding almost 5%. And even as the Fed cuts rates, that should still remain well above the type of I bond yields, that we're seeing. So yes, in short, we do think that there are some more productive areas of fixed income for new investments today, but we would continue to emphasize quality, U.S. government debt, investment grade municipals, even some investment grade corporates.
And if you did buy I bonds at 9.6% a couple years ago, what are your options today?
Well, the 9%, it's a little bit tricky because the 9% I bonds actually had zero fixed rate. The new I bonds do have that fixed rate available, about 1.2%. So better than just cash and not earning anything. But there is the ability to take on a little bit of interest rate exposure, lock in these yields in high quality areas that could be more productive than sort of accepting potentially lower interest rates, as if we are correct that inflation does continue this bumpy cooling process.
As investors are trying to get a good sense of how they can have and maintain a diversified portfolio, where do I bonds sit within that? Is there a good threshold that you recommend to clients to have some exposure?
I think it's a very personal decision because there is some peace of mind there for those that are concerned about a second, wave of inflation. But I would mention too that an individual in any given calendar year can only buy $10,000, worth of I bonds. So it can be difficult to get it to a really meaningful exposure for some investors. But for those looking for some really high quality inflation protection to complement other areas of the portfolio, they can make sense.
Chip Hughey, who is the Truist Wealth Managing Director for Fixed Income. Chip, great to have you here with us today, and thanks for breaking down the topic with us. I bonds, a lot of folks trying to figure out where it should sit within their portfolio. Appreciate it.
Thanks.